Hi there. Today we will tell you about the pension recycling in the UK, the legal strategies to reduce your taxable retirement income.
Okay, let's get straight to it. Starting in April 2027, your family could be hit with a £140,000 inheritance tax bill on your pension. And the crazy thing is, right now, that tax doesn't even exist. So over the next few minutes, we're going to break down exactly what's changing. I'll show you a really costly trap that tons of people are about to fall into. And then, most importantly, we'll walk through the legal, expert-backed strategies you can use to protect your retirement savings.
Right. Before we get into the nuts and bolts, it's really important you know where this information is coming from. This entire guide has been put together for you by the specialists at My Tax Accountant. They're one of the UK's most trusted accounting firms, and they've created this to help you navigate what's coming.
So, that £140,000 figure I just mentioned, look, that is not just some number I've pulled out of the air to scare you. For so many families, this is going to be a very real tax bill on a very real pension pot come 2027. You know, this single change is about to rewrite decades of retirement planning, which is why it's so important to understand what's going on.
So what's actually behind all this? Well, it's a massive shift in how pensions are treated for tax purposes after you pass away. Essentially, they're being brought in line with pretty much all the other assets in your estate. You see, for decades, pensions have been this kind of tax-efficient safe harbor. They've sat outside of your main estate, which means they've been completely exempt from inheritance tax. But from April 2027, that all changes. That protection is just gone. Most unused pension funds will be pulled into your estate, and they'll be subject to inheritance tax at a whopping 40%.
And just to give you a bit of perspective on that, HMRC already collected a record £8.2 billion in inheritance tax just last year. With this new change, you can bet that figure is going to climb a lot higher. Now look, these numbers aren't just my estimates. These are the government's own figures. They're projecting that over 10,000 estates will be dragged into paying inheritance tax for the very first time. On top of that, another 38,500 families will end up paying even more tax than they would have before. So stay with me on this, because this is going to affect tens of thousands of ordinary people.
Let's make this really concrete. Let's take a look at Amira's situation. Imagine she passes away in May 2027. Her estate includes her house at £400,000, ISAs worth £100,000, and then her pensions, both her own and one she's inherited, totaling £850,000. Now, before this rule change, her taxable estate was actually below the threshold, but with the pensions now included, boom, her total estate value jumps to over £1.3 million, creating a brand new inheritance tax bill of $140,000, literally out of thin air. Okay, so this naturally leads to a question that I bet a lot of you are thinking right now. All right, if this new tax is coming, can I just take out my 25% tax-free cash now, pop it straight back into my pension, and get another round of tax relief? It sounds smart, right? But, and you'll really want to hear this bit, that is a very dangerous idea. And that leads us straight into something called the pension recycling trap. Honestly, this is where most people slip up. They often have the best intentions, but believe me, the penalties are incredibly severe. So let's look at how HMRC officially defines this. They see it as using your tax-free cash to make another contribution that gets tax relief, basically generating an artificially high amount of that relief. To put it simply, they see it as you trying to get tax relief twice on the same chunk of money, and they've got very specific rules designed to stop you doing just that. And we're not talking about a little slap on the wrist here. If HMRC decides you've illegally recycled your pension cash, the total tax charge on that lump sum you took out can be, get this, as high as 70%. Just look at this. It really shows you the damage. You take out a £100,000 tax-free lump sum, money you were probably counting on for your retirement. But after HMRC applies all its charges, you could be left with just £30,000. It turns what feels like a clever move into an absolute financial disaster. Okay, but hold on. That huge tax shock isn't automatic. It only happens if a very specific set of conditions are all met. This next point is crucial, so let's break down exactly what HMRC is looking for. There are 5 red flags. Right. The key thing to remember is that HMRC has to be able to tick every single one of these 5 boxes. First, you take a tax-free lump sum. Simple enough. Second, the total you take in a 12-month period has to be more than £7,500. Third, your pension contributions then have to significantly increase, and that usually means by more than 30% of what was expected. Fourth, those extra payments you make must total more than 30% of the lump sum you took out. And fifth, and this is the big one, HMRC has to prove that the whole thing was pre-planned. And honestly, that last point is everything. This is a direct quote from HMRC's own manual. The onus is on HMRC to show that pre-planning took place. This is such a powerful protection for you, the taxpayer. The burden of proof is on them to show you did it on purpose, not on you to prove you didn't. So, when are you in the clear? Well, thankfully, HMRC is pretty clear on this. Say you get an unexpected inheritance or a bonus from work and you decide to put it into your pension. That's totally fine. Or maybe your salary goes up, so your normal percentage-based contributions rise with it. Again, completely fine. Remember, the rules are really about stopping you from recycling your own tax-free cash back into your own pension. So, for example, using your tax-free cash to contribute to your spouse's or your kid's pension, that's perfectly okay. Okay, so we know the dangers, we know the trap. The big question is, how can you legally reduce your pension's future tax bill without falling into that trap? Well, let's get into these smart strategies. Our first strategy isn't about some complicated loophole. It's about a fundamental change in how you think about your retirement income. It's a technique called smart income sequencing. For years, the standard advice from financial advisors was spend your ISAs first and leave your pension till last, because it was so brilliant for inheritance tax. Well, from 2027, that advice could be incredibly costly. The new goal is to intelligently draw down your pension during your retirement to gradually reduce the final amount that's going to get hit by that 40% tax. And here's how you do it. You use what's called Flexi Access Drawdown to take out just what you need when you need it. The whole aim is to methodically use up your tax-free personal allowance and your basic rates tax bands each and every year. The trick is to avoid taking out so much that you accidentally push yourself into the higher tax brackets. You're effectively drip-feeding the money out in the most tax-efficient way possible, legally shrinking the pot that will one day be taxed at 40%. Okay, now for something a bit more technical, but it's an incredibly powerful strategy that, honestly, not many people know about. It's a legal loophole that's actually built into the rules, and it's called the small pots provision. Okay, here's the part most people misunderstand. A small pot withdrawal of up to £10,000 is legally a completely different thing from a pension commencement lump sum, or PCLS, which is the official name for your normal 25% tax-free cash. And because a small pot payment isn't a PCLS, it doesn't trigger the recycling rules. It doesn't count towards that 7,500 test we mentioned earlier, and it doesn't trigger another nasty thing called the Purchase Annual Allowance. It's a totally separate beast. So, what does this all mean? The crucial takeaway is this. Taking a small pot payment allows you to withdraw funds, 25% of which is tax-free, and then legally reinvest that money back into another pension, and it won't be classed as pension recycling by HMRC. It's a legitimate way to achieve a very similar outcome, but it's done completely by the book. Okay, we have covered a lot of ground there. We've looked at the huge tax shift coming in 2027, that really dangerous recycling trap, and two powerful legal strategies to help you navigate it all. So let's quickly pull together the key takeaways. First step, that April 2027 date is absolutely critical. From then on, your pension is very likely going to be part of your taxable estate. Second, just taking your 25% tax-free cash and putting it straight back in is a massive red flag for HMRC. But, and this is important, remember that the nasty penalty is only triggered if all 5 of HMRC's tests are met. And finally, there are legitimate strategies like smart income sequencing and that small pots loophole that can help you. The bottom line is, careful professional planning is now more critical than ever before. All right, before we finish, we have to end with a very important disclaimer. Please remember that the information we've gone through today is for general guidance and educational purposes only. Tax rules are incredibly complicated, and they're always subject to change. Plus, your personal situation is completely unique, so it's absolutely essential that you consult with a qualified expert before you take any action based on what you've heard here today. So, to discuss your own specific situation and get advice that's tailored directly to you, we strongly recommend you contact the specialists who actually put this guide together, My Tax Accountant. All their details are on the screen for you now. And finally, if you found this helpful, please do subscribe to the My Tax Accountant channel for more essential tax updates to help you stay ahead of the curve. The whole pension landscape is definitely shifting, but with the right knowledge, you really can navigate it with confidence. Thanks so much for watching.